All right, what's up, YouTube? I know I'm kind of making these videos back to back, but I keep forgetting to add more things into the into these videos. But let's get back into it. So I'm sitting in finance, and kind of homework for us. When you get to that college level, for managerial finance, they teach you to, if you have a loser, let's say we bought retail, and let's say we have a loser for, okay, let's say we're buying at $48. Finance will definitely teach us to hold the stock, but we want to buy a winner to offset our losses. And that's typically not how we want to gain, how we want to set up our portfolio. So if you have a loser and it's continuing to lose you money, you definitely want to cut your losses on that, and get out of that stock and definitely get into something else. That is typically a no-brainer. So if you're in a penny stock and it's losing you a lot of money, you might want to get out of that simply because you might become a bag holder, and you might want to get out simply because the volume might leave out of that stock. So that's one way to look at it. So a lot of people, they typically set their portfolio up to have, some stocks, some bonds, some gold. And if you're younger than 30 years old, you definitely don't need to be buying gold. You definitely don't need to be buying bonds. So typically, you want to look for things that are more riskier for you. So you want to look at, growth stocks. You want to look at probably some penny trading here and there, but you never want to actually, put all your account in there and start to invest in those penny stocks, simply because, like I said, it definitely does open you up to a lot of losses to come in the near future. So typically when that does happen, you want to jump in and you want to start to learn the market a little bit better. That's why I have that technical analysis video for you guys. So $40 is the low, 45 will definitely be a high. If we can break out of that, $50 will be the top. So that's one way to look at retail sector. It does move pretty slow, but at the same time, if you're learning about finance, I know one stock that we're learning about is ExxonMobil. We're learning how that trades, and a lot of people are seeing ExxonMobil as a pretty good investment. But as you see here, it hasn't really made anybody money yet, simply because the highs were what, $85. Now we're back at $80, and simply the people that do invest, they typically buy more as the stock goes up. They really don't understand. They really don't understand the technical analysis. So when they see a stock on a decline, they typically treat it as a chance to buy more shares, and they do increase their position. And there's really nothing wrong with that. But at the same time, if you're into maximizing your gains, you really don't want to do that. You want to look for growth. You want to look for stocks that are not declining all the time. You definitely want to look for stocks that have a pattern and typically want to go up. So, like, I know penny stock was mentioned like this. Pharmaceuticals, Clayton Wolves Industry. This has definitely got super high for the people that bought it at $14. Now, people are starting to look back and say, okay, now we've become rich, or now we've met our financial goals. It might be time to sell. As we see, it's been kind of stagnant right here at this level. They might look for a reverse split, or they might look for a split in shares. So there's definitely something that you might want to look out for. But typically when splits do happen, they really don't alert you about it. That's typically something that the board talks about. If they actually get a split to happen, that's typically what happens. They alert you before it happens. But that's all I have for you guys. I definitely want to keep you aware of, the things that people are learning in finance. I know if you see a loser happening, usually that's time to go ahead and cut your losses and try to build it up somewhere else. But people usually, they start to buy right here. And typically, we only had 2 earnings for this stock. And let's see if we turn positive here. All right. Okay, so it beat earnings. Let's see if it was positive here. Missed earnings on the first time, beat earnings on the second time. So we're not seeing consistent beats, but Twilio was definitely a consistent beat. And we're just now seeing if we can actually get to profitability here. And, we might see that 35 handle be achieved, or we might see a breakout in shares, simply because this stock is definitely a low float. It's a way better investment than Snapchat, and people are starting to look at Snapchat as like a really bad company, and that's typically how I look at it. Facebook is definitely taking them out. They're doing just about everything Snapchat does and more. So as you see right here, we have that $143 handle being achieved by Snapchat, and we might see sideways trading here until Facebook can actually start to see some bullish sentiment going on for the stock. But definitely trying to take out Snapchat every chance they get. They have Instagram stories, they have Facebook stories, and that's typically how competition happens. So they weren't able to buy Snapchat for $3 billion, but they're definitely gonna take out Snapchat by doing their own software, and just about doing everything Snapchat does by even more, and also including I would say sports games. Snapchat's trying to do TV shows, but at the same time, sports games will definitely hold more leg, simply because there's more ad revenue in that, and there's more exposure, and people are actually gonna try to watch those games on Facebook, like Twitter. Twitter definitely did see some really good exposure for those NFL games, but when you think about it, NFL games have definitely seen a drop off in viewers. So typically, you want to be well versed in each issue. I know a lot of these things are privately held, but at the same time, if it has something to do with your stock, you really want to pay attention to it, so that way you know that your company is maximizing growth. So that's really the point of this video, being able to maximize growth. So if you see a loser like Snapchat and you think it's a really good buy, right now you're losing money, you really haven't actually broke even yet. Let's say if you bought it at IPO price at about $23, let's say you got lucky, you got filled at $23. As you see, you've only broke even about 1, 2, and the rest is over. You only broke even about 3 or 2 times, and after that the stock fell down. So a lot of people are starting to buy Snapchat, but me, I really want to wait until we can see an actual four quarters worth of growth before I actually can sink my teeth into it. So ELF only has 2 quarters, and Twilio has now 3 quarters of good growth, and we're gonna see if it's gonna break even. So I might actually buy this and include this in my portfolio, because all of these handles, they could be achieved once the stock starts to see growth over time. So $70 being the high, and it really doesn't take much for Twilio to move. So we see $23 all the way to $70. People were buying at this $70 handle, so let's not get that confused. So $23 to $70, and it only took July, August, September, October, so about 4 months to get that high. And since it's a low float, like I said, a lot of buyers can really move this stock up, and a lot of sellers can move this stock down. So we see it come off of that bounce period, and now we're kind of, if we get a good earnings estimate, we might become overbought, and 35 might be the support here, and we might see it go higher. So pay attention to that. I can't think of any more growth names. Let's see here. Domino's Pizza is definitely a growth name. Let's not get that confused for a boring stock, as we see 116, 192. So you've seen just about over $70+ a share profit. So let's not forget about Domino's Pizza. It definitely does good. We can say Papa John's. Let's see what Papa John's have done. Papa John's, definitely good investment, $54. We see $90 handle being achieved. So you just about almost doubled your money there. So when you start to get close to doubling your money, that might be a sign for you to go ahead and take some profits, simply because you really want to take gains, and any chance you get them, and start to reinvest on a pullback. And typically, that's not what's being taught in school. But what is being taught in school is to hold on to a stock even though it's a loser, and definitely buy more on a pullback. Typically, we want to maximize growth, and growth is definitely not being maximized. If you're doing that, you're simply going to have these crazy returns, and typically that's not what you really want here. So leverage is definitely something that you want to look out for. $15 the bottom, $22 the high. And as we see here, this is definitely one way to make money on oil going up. Leverage 3 times. It was once UWTI, but they switched it back over to UTW or UWT. This is being taken over by Citigroup. I think this was by Credit Suisse. So DWT was taken over by Citigroup as well. As you see, $33 to $25. You could have made some money being bullish on gold, but now, this is oil. So being bearish on oil, if we do see a overbought period here or oversold period here, this definitely might open up the door for 25 handle to be achieved. So we want to have growth in our name, or we want to have growth in our portfolio, and we want to focus on every single thing that's going on in the market. So we don't want to be exposed to any losers. We want to take everything that's going to be growing over, over a certain period of time, and buy those on pullbacks. So we see Cisco definitely oversold. You might look to buy shares in that. That is cybersecurity. Like I said, cybersecurity is definitely the thing for the years to come. And you want to be behind, a quality name, and you want to be behind a growth sector. This is definitely a growing company. It is going to continue to grow, and it's typically taking away a lot of market share from other cybersecurity firms. So you want to focus on those rather than focusing on a mutual fund. Mutual funds, they typically, they charge you a set amount to hold, to hold your money and things like that. But ETFs, I don't think they charge an actual managerial, a management account type of thing there. That's one of the advantages of having an ETF. It definitely does give you the bang for your buck, and typically it doesn't bore you to death when you do invest and start to hold in them. So broad-based, let's see, a broad-based investment. So if you look for technology, we see it's being oversold. So I might add some technology in my portfolio, but at the same time, I'm invested in Cisco. So that's typically my technology here, and that's typically what might be bringing, the technology sector down. So we want to focus on oversold names, get out of the stocks when they're overbought, and look for something else that's oversold. And we continue that pattern until we start to see 100%. And you can easily see 100% if you follow that strategy of buying oversold, selling overbought, and keeping that pattern the same. And we really don't want to, start to feel emotionally attached to these stocks. UPS was definitely one I started to get emotionally attached because I saw the dividend come through, and we see it was oversold right here, ran up to 109. I was buying at 105, ran up to 109. I continued to hold it because I thought, it would probably get past this 111 level, but I really, I wasn't paying attention that the stock is definitely going to get checked down because it has better competitors such as FedEx. That's one. FedEx is having a hard time breaking past that $200 level. As we see here, we see a hard time, and we see just a really bad knife pattern here. So let's check out the transportation sector. So as we see here, it's just about oversold, and I'm pretty sure UPS and FedEx are definitely bringing those down. And this is definitely a broad-based investment over the transportation sector. So this is typically what you want to be exposed to if you're looking for long-term growth. But if like I said, if you're a younger person in college, you want to focus on those growth names. So you might want to buy a FedEx and take that game because if you go with the IYT, it definitely doesn't give you enough growth in it to actually be worth your while. You want to look for leverage, and you want to look for individual companies. So that's all I want to tell you guys. Remember, we don't trust mutual funds. We get and leverage ETFs, and we trade those ETFs. We might invest in those ETFs if they do follow certain indexes that show growth at that time, and we definitely get out of them when they become overbought. So that's all I have for you guys. Take care.